Hello. In this video, we're going to go through how to convert accounts from a cash basis to accrual basis. But first, we're quickly going to go through what is cash basis accounting. Cash basis accounting is when a company records its income and expenses based on cash inflow and cash outflow, or cash collections and cash payments. When they receive income for a sale that's made, when they receive cash for when a sale is made, that's when they record their income, regardless of when they earned it. When they actually pay cash for an expense, such as supplies expense or insurance expense, that's the expense amount, whatever cash payment they made, not necessarily in what resource was used for that expense. The accrual basis accounting, which is what most large corporations use, measures the accounts based on when income was earned and resources were sacrificed, or when expenses were used, not necessarily when cash was received or paid. We're going to go through 3 examples. So example number 1 relates to prepaid insurance. So in this example, suppose a company paid $20,000 cash for insurance during the fiscal year, and you determine that there was $5,000 in prepaid insurance at the beginning of the year and $3,000 at the end of the year. Basically, it says, okay, how do we determine what our insurance expense for the year under the accrual basis? You're going to take the information that the problem gives you to figure this out, to figure out the insurance expense based on the accrual basis. We're given the balance at the beginning of the year, $5,000. That's a given. We're given the balance at the end of the year as $3,000. And we're given the cash paid during the year for that prepaid. It was $20,000. Under the cash basis, the insurance expense would be $20,000 because that's the actual cash payment that they made. However, under the accrual basis, that is not what is happening. What is happening, if I draw my 2 little T accounts here, and this one will be for prepaid, and this one will be for insurance, the expense. Prepaid is an asset, so I'm going to go with my debit side. My beginning balance was $5,000, right? My ending balance was $3,000. And I know my cash paid was $20,000, which would increase my prepaid. So I'm going to go right here. It's so small. And because this prepaid would be debit, prepaid, credit, cash. Just so that's why it would be expense under the cash basis. To figure out the accrual, if we have 5 plus 20 is 25, then that means we had to have credited prepaid by 22 during the year to get to an ending balance of 3. If we credited prepaid for 22, that means we debited the related expense, which is insurance expense. So under the accrual method, your insurance expense is $22,000. Our second example is taking from cash to accrual based on a payable. When you do cash to accrual accounting, you have to analyze the balance sheet accounts associated with the P&L account that you're converting. So suppose a company paid $150,000 for salaries to employees during the year. So under the cash basis, whatever cash you paid, this would be your salaries expense. So under the cash basis, your salaries expense would be $150,000. But we're doing accrual basis. And you determine that there was $12,000 and $18,000 in salaries payable, the balance sheet account, at the beginning and end of the year, and determine the salaries expense for the year under the accrual basis. Well, what do we know? We know beginning balance is $12,000 in our salaries payable account. Our end of the year is $18,000, and we paid $150,000. We go down to our T accounts for our salaries payable and the related salaries expense, and we put in what we know. We know that our beginning balance is 12, and we know that our ending balance is 18 and the amount we paid is $150,000. When this $150,000 was paid, it was, if we paid out salaries of $150,000, we would have had a credit to cash for $150,000, and our debit would have been to salaries payable, because now we don't owe it anymore because we actually paid it, right? That's this entry right here. Just want to show you how this came about and how it relates to this $150,000. So just by virtue of plugging it in, if I take my $12,000 minus $150,000 plus some amount equals $18,000, we know that that amount is going to be $156,000. So here we have a credit for $150,000. I'm just going to make space because the slide is very small. But for this $156,000, a credit to salaries payable, is $156,000, and so that it must be that my debit was to salaries expense for $156,000. This is a credit. So that's how, by knowing that my salaries payable was credited $156,000, I just know that way that my salaries expense would have had to be debited. So my salaries expense is $156,000 under the accrual basis. Third and final example is using T accounts. Assume the amount of cash collected from customers during the year was $220,000. So that tells us cash collected from customers. That would have been sales revenue or some sort of revenue. In this count, I guess it's salaries revenue for under the cash basis. But you know that accounts receivable at the beginning and end of the year were 45 and 33 respectively, and you have to determine the sales revenue. Let's see, I think this should say sales, not salaries. That's the confusion. Okay, so it tells us that our big accounts receivable, which is naturally debit balance, beginning balance was 45, ending balance was 30. Sorry, the ending balance is 33,000, and it tells us the cash collections were $220,000. So by the way, this would be again the sales revenue for under the cash basis. But this was when they collected cash. When they collected cash, they debited the cash for $220,000, and they credited accounts receivable for $220,000. That was that entry. That's how it works. So this is how this credit comes into play. So our plug is going to be 208,000, because 45 plus X minus 220 equals, right? It's just 45,000 plus X number minus 220,000 equals 33,000. It's just the algebra itself for X. So the debit to accounts receivable is 208,000. Why did we have a debit to accounts receivable for 208,000? I'm gonna just erase this to make more room. But you debit accounts receivable for 208 because you made sale for or sales, I should say, or revenue for 208,000. You just haven't received the cash for it yet. So our revenue, that's where this credit comes from, under revenue, and that's the accrual basis revenue. Went through 3 different types of examples, converting from the cash basis to the accrual basis. This is kind of little just, summary. When you have an asset, when you convert the cash basis to accrual basis, this is what you do. Personally, I wouldn't to just memorize this, I would go through the T accounts because that's going to give you the most clear picture of what is happening.